Hey, how's it going, everybody? It's Mike Weber here, and today I wanted to cover some updates that have come out about the U.S. housing market since my last video. And unfortunately, we're seeing some major signs of weakness with a lot of this new data that's come out. So to start out, as we know, a week or two ago, the Fed raised the federal funds rate. And of course, we're seeing a corresponding increase now in the 10-year Treasury rate, which I know today was up at some point as high as 3.26%. This data is about, 5 days old. So, it very likely could go higher than this in the next week or so. And then, of course, correspondingly, looking at the 30-year fixed rate mortgage, that has also peaked to the highest level we have seen since, probably 2011, it looks like. Yeah, somewhere thereabouts, so 2011. So as those mortgage rates continue to rise, that's going to continue to affect affordability in a bad way. And many people think, 4.7%, it's still low. And that's true, it is low. But the thing is that depending on where somebody lives and where they're buying, the average buyer at the margin, isn't really even able to afford a home that maybe is ideal for them, or maybe even in some cases, one that actually meets their minimum requirements or standards. So as rates trend up, over time, 1/4, 0.5%, 1%, that zaps their buying power even further and limits the amount of money that they can finance or the type of home that they can purchase, and makes their prospects look even worse, as time goes on. So next, I want to show you a quick article here from out of the Dallas News here, and I'll have links to all of the articles and stuff that I'm covering in the notes section below. And here we have bad news for home sellers. DFW has one of the biggest U.S. home listing gains. And as we go into the data here, we can see they have an uptick of 14% from the same period a year ago, according to Realtor.com. So this is definitely significant. We're starting to see this in most major markets throughout the country. Nationwide, home inventories are up at a 5-year high, according to Realtor.com. Here in this article by CNBC, a red flashing light in housing market could spell trouble for the economy. So in this article, they're pointing to a home price index that they're using that's different. It's called the ECRIS U.S. Leading Home Price Index, and they're saying it turned negative last April. So this is different than the Case-Shiller Home Price Index, which a lot of people seem to cite. And according to this index that they're using, as of April, we've already started to go down, and we're in negative territory for U.S. home prices currently. And of course, this would also similarly match the sold price index that I've shown you before in the past that I pulled off of Fred. Next, let's take a look at this article by Adam Data. U.S. home affordability drops the lowest level in 10 years. Obviously, we know this is happening as prices have continued to rise and interest rates are now continuing to rise. Home prices less affordable than historic averages in 78% of local markets, 30% of population in markets requiring $100,000 plus in annual income to buy a home. And again, that's pretty significant. Obviously for a lot of families throughout America, that's a pretty high annual income that most people don't earn. Definitely interesting to take a look at that, and just kind of further confirms the trends that we're already seeing. Next, as we've seen an uptick in the federal funds rate, and that's kind of rippled throughout the bond market, obviously causing a detrimental effect to the value or the price of bonds as those interest rates continue to rise. So this article just shows us here that obviously we're up versus a year ago about 0.5%. I think this rate here is pretty low actually compared to anything I'm seeing. I'm seeing stuff north of 5% out in the market, 5.5% in some cases. So I would say we're probably up between 1 and 1.5% since 2017. But this is a good article. It has some interesting stuff about interest rates, talks about how ARMs are dead. Obviously, nobody in their right mind would be financing, with an ARM right now, knowing that interest rates are going to rise. Maybe they would, but of course, it's probably not the wisest thing to do. So next, I want to talk a little bit about a bunch of headline articles that have come out recently about different lenders and banks and mortgage companies laying people off. The numbers are not massively significant, but here's an article that just came out on Housing Wire that Movement Mortgage is laying off, what is it, a couple hundred people or just under 200 people or something like that. There's a video in here where he's talking about the decline in the housing market, etc. Pretty good one to watch. Obviously, a week or so or a few days ago, we saw Chase is laying off 400 mortgage banking staffers. And again, Wells Fargo, as of a month or so ago, the news came out that they were laying off 638 mortgage lending employees. So definitely we're seeing a trend here when it comes to lenders. They're laying people off. There's less loans that are taking place. Less applications are going in. And this is starting to become not just a one-off, but certainly a trend. And it looks like it's going to continue on. Next, here's another article out of Housing Wire. Redfin, supply of for-sale homes surge in the West. San Jose experienced the largest year-over-year supply increase across U.S. metros. So I'm seeing the same thing here in Los Angeles. I won't go into too much detail here. According to the company, in 4 weeks ending on September 30th, San Jose experienced the largest year-over-year supply increase across 170 U.S. metros, climbing 86.7% compared to, I think they mean 2017 here. So we're seeing this across the board. Here are the areas which showed notable changes. Seattle went up 53.9%, Oakland 28.9%, Portland 27.5%, San Diego 26.8%, San Francisco 22.5%. Now, if inventory just continues going up like that, obviously there's going to be homes that are sitting on the market. We're also seeing sales, drop in all of these areas as well, which means there's just more and more properties that are sitting there. And so, it would just be a matter of time before we see larger price decreases as people want to get out of the market and get their homes sold. Here's another article out of National Mortgage News. Pending home sales fall for an 8th straight month. So rising home prices and depleted housing inventory led to another drop in pending home sales, according to the National Association of Realtors. The index declined 2.3% year over year in August and 1.8% from July. So this means that across the board, the number of sales is falling, and obviously this has a detrimental impact on prices as more and more homes pile up and sit on the market. Next, another article out of Housing Wire. Multifamily investors are still okay with low cap rates, but that could change soon. This is a great article because it says that apartment acquisitions have averaged a 5.6% cap rate since 2017 with very little variance to date. And so as we know, interest rates on multifamily properties have continued to rise throughout that time, but investors have still been buying these properties with these relatively low cap rates. And so the interesting thing is that rent growth just finally went flat. And so I found this on apartmentlist.com, and this is just totally awesome. So I'll link it in the notes below, as I said. And this just breaks down everything that's going on with rents on a national level. And what we're finding is that as you see here, the 2015 to 2016 and 2016 to 2017, we had this incredible growth curve. And then all of a sudden, 27 to 2018, look what happened. I mean, we started out low, we kind of started to do okay, and then now we're dropping off again. And really, we're just below 1% growth. So rents, have definitely flattened out. Now this goes into detail and it'll show you, where rents are growing versus where they're falling. It's a really nice infographic that's interactive. You can see the red is negative, the green is positive. So it's still growing in certain areas, but not by that much anymore as compared to years past. And there's a whole bunch of charts and stuff that are really interesting in here. So I would definitely take a look at this article. Shows you the fastest growing rent areas here and some of the cities that are experiencing rent declines. But of course, not a lot of cities are experiencing declines. However, up here you see that the growth rate, isn't as substantial as it probably was in years past. So we're talking, anywhere from 1% to maybe 4.5% max or something like that. And then here, finally, it kind of shows you month over month change and then year over year change. And as you can see in a lot of these major cities, there's hardly any rent growth year over year at this point. So as this continues to take place and interest rates rise and prices still rise in certain areas, multifamily investors are just not going to be able to buy a property and have it make any sort of financial sense moving forward. So obviously prices will have to come down. Otherwise, people will stop buying the properties, and then sellers will have to lower the prices if they actually want to get them sold. So I hope this information was useful and valuable. If so, do me a favor, click the like button, click the subscribe button. I really appreciate everybody who's been liking and subscribing so far, and look forward to seeing you on the next one. Thanks so much.